the USD VND exchange rate stood at 26,290.0000 on July 2, 2026, marking a modest decline of 0.04% compared with the previous trading session. Although the daily movement was relatively small, it reflects the continuous fluctuations that occur in the foreign exchange market as investors, businesses, and financial institutions respond to changing economic conditions and market sentiment. Even slight shifts in the exchange rate can attract considerable attention because they influence international trade, investment decisions, import and export costs, and the purchasing power of both currencies. In this instance, the marginal decline suggests that the Vietnamese Dong gained a small amount of strength against the US dollar during the latest trading session. While a movement of just 0.04% may appear insignificant at first glance, currency markets often experience gradual changes that accumulate over time, making even small daily adjustments meaningful when viewed within a broader economic context. Looking beyond the daily performance provides a clearer understanding of the recent trend. Over the past month, the Vietnamese Dong has appreciated by approximately 0.21% against the US dollar, indicating a period of modest strengthening. This monthly gain suggests that the Dong has benefited from supportive economic conditions, balanced foreign exchange demand, or improving investor confidence in Vietnam's economy. Currency appreciation of this nature can result from several factors, including strong export activity, healthy foreign direct investment inflows, increased tourism revenues, stable inflation, or effective monetary policies implemented by the country's central bank. While a monthly gain of 0.21% is relatively modest, it nevertheless demonstrates resilience in the Vietnamese currency. During a period when global financial markets continue to face uncertainty from shifting interest rate expectations, geopolitical developments, and changing trade patterns, despite this recent monthly improvement, the broader annual picture tells a slightly different story. Over the past 12 months, the Vietnamese Dong has declined by approximately 0.34% relative to the US dollar. Although this represents only a small depreciation over an entire year, it indicates that the US dollar has maintained a slight advantage during the longer-term period. Such annual movements are influenced by numerous macroeconomic factors, including differences in economic growth, inflation trends, monetary policy decisions, interest rate differentials, international capital flows, and investor sentiment toward emerging markets. A depreciation of just 0.34% over 12 months suggests that the Vietnamese Dong has remained relatively stable, despite periods of global economic volatility, demonstrating the effectiveness of Vietnam's financial management and its efforts to maintain currency stability. Exchange rates such as the USD VND are among the most closely monitored indicators in international finance because they directly affect businesses engaged in cross-border trade. Vietnamese exporters often benefit when the Dong weakens slightly against the US dollar because their products become relatively less expensive for foreign buyers, potentially increasing export competitiveness. Conversely, a stronger Dong can reduce the cost of imported raw materials, machinery, fuel, and consumer goods, benefiting companies that rely heavily on imported inputs. As a result, maintaining a balanced exchange rate is important for sustaining economic growth while controlling inflation and preserving international competitiveness. The quoted USD VND exchange rate represents the amount of Vietnamese Dong required to purchase $1. In practical terms, an exchange rate of 26,290.0000 means that $1 can currently be exchanged for approximately 26,290 Vietnamese Dong. This quotation serves as a benchmark for financial institutions, importers, exporters, investors, multinational corporations, and travelers conducting transactions between the two currencies. Because exchange rates fluctuate continuously throughout the trading day, market participants closely monitor even minor changes to assess trends and adjust their financial strategies accordingly. One important concept in foreign exchange markets is the spot exchange rate. The USD VND spot exchange rate refers to the current market price at which US dollars and Vietnamese Dong can be exchanged for immediate settlement. In most international currency markets, immediate generally means that the transaction is settled within 2 business days, although market conventions may vary slightly depending on the currencies involved. The spot rate reflects the real-time balance between supply and demand in the foreign exchange market and incorporates all currently available information regarding economic conditions, monetary policy expectations, political developments, and investor sentiment. Spot exchange rates are widely used in everyday financial transactions because they represent the prevailing market value of one currency relative to another. Businesses importing goods from Vietnam or exporting products to the United States frequently rely on the spot market to complete immediate currency conversions required for trade settlements. Likewise, tourists exchanging currency before international travel, multinational corporations paying overseas suppliers, and financial institutions managing short-term liquidity all utilize spot exchange rates to execute transactions at current market prices. The value of the USD VND spot exchange rate changes continuously throughout the trading day as buyers and sellers enter the market. Increased demand for US dollars tends to push the exchange rate higher, meaning more Vietnamese Dong are required to purchase $1. Conversely, stronger demand for Vietnamese Dong relative to the US dollar generally causes the exchange rate to decline, reflecting an appreciation of the Vietnamese currency. These movements are driven by a wide variety of economic events, including inflation reports, employment data, central bank announcements, trade statistics, geopolitical developments, commodity price fluctuations, and changes in global investor confidence. In contrast to the spot market, the forward exchange rate represents an agreement between two parties to exchange currencies at a predetermined rate on a specified future date. Unlike spot transactions, which involve immediate settlement, forward contracts allow businesses and investors to lock in an exchange rate today for a transaction that will occur weeks, months, or even years later. This provides valuable protection against the uncertainty associated with future currency fluctuations. For example, a Vietnamese company expecting to receive payment in US dollars several months from now may enter into a forward contract to secure today's exchange rate. Doing so protects the company from the risk that the US dollar could weaken before payment is received, potentially reducing the value of its future revenue when converted into Vietnamese Dong. Similarly, an American importer planning to purchase goods from Vietnam at a later date may use a forward contract to lock in current exchange rates, thereby protecting against the possibility that the Vietnamese Dong could strengthen before payment becomes due. Forward exchange rates are especially valuable for companies operating internationally because they facilitate financial planning and reduce uncertainty. By eliminating unpredictable currency fluctuations, businesses can prepare more accurate budgets, forecast future cash flows with greater confidence, and protect profit margins from adverse exchange rate movements. Financial institutions, investment funds, and multinational corporations routinely use forward contracts as part of broader currency risk management strategies. Although forward exchange rates are quoted today, the actual exchange of currencies occurs only on the agreed future settlement date. The forward rate itself is determined by several factors, including the current spot exchange rate, interest rate differentials between the two countries, the contract's maturity period, and market expectations regarding future currency movements. Consequently, forward rates often differ slightly from prevailing spot rates, without necessarily implying that traders expect the currency to move in a particular direction. The relationship between spot and forward exchange rates plays an important role in international finance because it reflects market pricing rather than simple forecasts. Investors frequently analyze both rates together to better understand financing costs, interest rate expectations, and opportunities for managing exchange rate exposure. Businesses engaged in long-term international contracts often combine spot transactions with forward contracts to optimize cash flow management while minimizing financial risk. For Vietnam, maintaining relative exchange rate stability remains an important economic objective. Stable currency movements encourage foreign investment, support international trade, reduce inflationary pressures associated with imported goods, and strengthen overall confidence in the country's financial system. Vietnam has become one of Asia's fastest-growing economies through expanding manufacturing capacity, increasing exports, strong foreign direct investment, and continued integration into global supply chains. These developments have contributed to relatively stable demand for the Vietnamese Dong despite periodic fluctuations in global financial markets. Meanwhile, the US dollar continues to serve as the world's primary reserve currency and remains the dominant currency for international trade, global investment, and cross-border financial transactions. Decisions by the U.S. Central Bank regarding interest rates and monetary policy often have significant effects on the value of the dollar against emerging market currencies, including the Vietnamese Dong. Higher U.S. interest rates generally attract international capital toward dollar-denominated assets, strengthening the dollar, while lower interest rates may reduce demand for the currency. Ultimately, the latest USD VND exchange rate of 26,290.000 reflects a market that remains relatively stable despite modest day-to-day fluctuations. The Vietnamese Dong's slight monthly appreciation indicates improving short-term performance, while the limited annual depreciation suggests that the currency has maintained resilience over the longer term. Understanding both the spot exchange rate, which governs immediate currency transactions, and the forward exchange rate, which enables future exchange at predetermined prices, is essential for businesses, investors, policymakers, and anyone participating in international commerce. Together, these exchange rate mechanisms form the foundation of modern foreign exchange markets, helping facilitate global trade, manage financial risk, and support economic activity across borders.